Hello, we're continuing our discussion with the largest issuer of gold ETFs, State Street Investment Management and Akash Doshi from that firm. On this episode, we'll jump into the what, where, and how of investing in gold. So let's do that after the bell. Now you see what I'm saying?
Now we got it.
There you go. It's over. Who's back at you?
Perfect.
Jim,
Look at that.
Jim lives near me. We're neighbors, okay? And I think, Jim, you've been over to the house. You probably see me that I should have been a cowboy, probably in a past life. Right?
There's no question about it. You should have been a cowboy for sure. And you should put that hat on. And by the way, guys like you and I, we could benefit from wearing cowboy boots too, because they give us a couple inches of height as well. Just side note.
And you know, we're not getting any taller. We're only getting shorter, right?
That's true. Yes.
So,
yeah.
Gosh darn it.
I thought you were going to say to cover up the head a little bit and
That's a good point.
hide the forehead.
We have operations for that now. So Akash, welcome to the show. The second part
Good to
of
be
it,
back.
I should say. Thanks for coming on. For the folks watching, we already did one episode. We're not sure what we're going to call it yet, but we'll have a cool name eventually. So this is episode 2, and the what, where, how of investing in gold. We're going to start there. With me, Bobby Iaccino. Oh, I almost said Bobby Iaccino. No.
That's Iaccino.
Iaccino, like cappuccino.
Like
and
cappuccino.
Jim Iuorio. One of my
Yeah.
Both these guys are great pals, been in the trading business forever, like me. And we're going to talk gold today. They're here because I can't talk gold. Only they can, and Akash. So I'm just going to be moderating. So you bear with me, everybody. We're going to get to the end of this, and it's going to be great. So, Akash, give us a brief word about yourself first, and then we'll get right to the questions.
Sure. So Akash Doshi, I'm global head of gold strategy at State Street Investment Management. Been with the firm for 7 months. Spent most of my career in fixed income research and trading. Most recently as America's head of commodities research at Citigroup Global Markets. And State Street Investment Management is the 4th largest asset manager in the world, one of the largest issuers of ETFs in the world, and the issuer of GLDM, which is the largest gold ETF suite on the planet, with roughly 110 billion assets under management.
Awesome. Okay. Very good. Let's get to it. Okay. First question. Can you share how individual investors typically seek access to invest in gold? In my mind, I'm thinking I'm stacking these gold bars, and whenever I need a new something, or I go down to the basement, pull one out, and bring it over to the jewels and see how I do with it. But I know that's not the case. So tell us how the typical investor gets access to this product.
Sure. Yeah, I mean, look, you can pull a Scrooge McDuck and have a money bin and swim in it. It is a physical asset, bars and coins. That being said, I think there's a lot of easier ways to access gold. I think one of the easiest, and I'll just be honest, parroting a little bit of State Street Investment Management product, but there are other competitors out there, is gold ETFs. Why do those wrappers work really well? They're physically backed ETF tickers, so they own gold in the underlying, and they trade just like your stock. So just like Nvidia would, just like Microsoft, just like Amazon stock. You can buy them and sell them in your brokerage account. And within that context, the ETF wrapper has some advantages. It ends up, it's a 33 Act fund. You don't have to pay for insurance. The funds are typically audited financially as well as physically. So a lot of the maintenance of owning a physical asset is kind of taken to the side when you have the ETF exposure. I'd also add, I personally like seeing an ETF holding within my broader financial portfolio. If you own gold and you're putting it under the mattress or in your master bedroom safe, one, that could be a small quantity. 2, you have to pay for insurance, transport. Liquidity can be an issue because you can have a very wide bid-ask spread to try to get rid of physical gold. ETFs, particularly GLD, which is the most liquid ETF, gold ETF in the world, has a bid-ask spread less than a basis point. So I think within that context, the ETFs are definitely a way to get exposure. There are other ways, though. Gold, you can get exposure from the physical all the way to exotic derivatives. So in the over-the-counter market, the benchmark futures and options exchange is COMEX, so you can get access there. But I think the ETF is a really strong way for a retail and intermediary investor to get exposure to gold and physically backed gold in particular.
Okay.
Can I add to that real quick, Lex?
Yeah, please.
Because Bobby and I have been futures traders for 38 years for me, 36 years for Bobby. Which, by the way, I was hired by Goldman Sachs in 1987 because they were adding. Oh no, it gets better because they were adding staff because they were opening up the gold pit at the CME and the IMF. Now that pit didn't last very long because they couldn't steal it away from COMEX, and it closed. But so I've been kind of fated to be a gold bug for the entire time. But now futures. For most commodities, Bobby and I would say, if we want to buy the commodity, you buy the commodity, and that'll be futures. Well, up until recently, the smallest contract that the CME had was 100 ounces of gold. That prices out some retail traders right away. As Akash mentioned in an earlier conversation that wasn't on this, is that with futures, you constantly have to roll. So it, for being a set it and forget it investment, is not great. The physical gold, you said the cost of having physical gold. And the second thing, this is not a joke because you also have to talk about security systems. I have guard dogs and guns. That all costs money. I like having guard dogs and guns. We all smile, but I'm not joking. I have gold and I have guard dogs and guns. So the point being is that it can be a pain to be in charge of your custody of the asset. Now, the beauty of it is it has no counterparty risk, but then you are in charge of storing it. The beauty of gold, and now some of the GLD ETF, some of the critics would always say, well, it's a trading vehicle. If we ever got to this prepper scenario where everything really hit the fan, what good's your GLD going to do you? Well, come on. That's a dumb argument that's such a small chance. What we invest in the GLD for is to take advantage of the different fundamental shift changes in gold, like we're seeing in the central bank thing too. So you can participate in that on a broad scale and not have to worry about rolling and not have to worry about shooting people. Does that make sense?
To me, it does. Bob, any thoughts there?
Yeah, I generally answer this question differently depending on whom I'm speaking to. I mean, you can't buy. There are places that will sell you a gram of gold, if you're just starting out in the gold world, but you're not. I mean, you're talking about something that's smaller than a dime and thinner. So what are you going to do with it? I mean, I lose socks. I would lose that, right? I mentioned buying my first gold coin in the last show in 1986. I think everyone at some point should buy a gold coin or something gold they can hold in your hand. If you already got a pinky ring, you already took care of that. I have several. Gold ETFs are the best way for the average person to get involved. If you're already a futures trader, you've already done it. We're actually not even talking to you. But the retail people, the ETF is the simplest, safest, and most efficient way to get involved because most of you have already traded or bought stocks. If you're talking about buying and holding gold, which I think 98% of people should do on some level, it's going to be the easiest way. If you're talking about massive amounts of capital, talk to your advisor to find out what the best way it is. But I think a lot of them will lean ETF and they'll lean GLD, and they should.
Okay, great points. Akash, anything else on that one?
No, I think Bobby said it well, and Jim said it well. So great.
Akash, I have a question for you.
Well.
When was the GLD first? When did it first unveil itself? When did it start?
November of 2004. So we just finished our 20th anniversary last year. This is our 21st year in operation, and that's gone through the global financial crisis, the COVID pandemic, the Russia-Ukraine war. And here we are, not only alive and kicking, but at record AUM levels in 2025.
And look, can I just add something quick to that for the people watching too? That's just 20 years ago. Prior to that, the retail investor would have had to jump through massive hoops and climb hurdles to be invested in gold, unless you wanted to go out and stack bars and buy dogs. So that to me is a monumental shift in the access to the asset, and we're appreciative of that.
Yeah, that's great. Okay, so timing the market is difficult, right? At least for me, it is. I'm never good at that. Even though there are clearly times when certain assets are in favor tactically, what are the strategic benefits for gold, would you say?
Yeah, Lex, look, I think in the last episode, all of us talked about some of the current trends, dollar, alt fiat demand, and so forth. But just taking a big step back, gold works tactically, especially in an environment like this, but it should be a part of your strategic core portfolio holding. And why is that? One is capital appreciation over the long term. So if I go back to the 1971 Nixon shock and the US exiting the Bretton Woods, on average, gold has returned 7 to 8% in nominal terms. In real terms, so inflation adjusted, it's returned about 3 to 4% annually on average. Now, of course, past performance is not indicative of future returns. That being said, what history has shown in the free-floating foreign exchange era is that gold beats cash plus inflation. So capital appreciation is one part of it in the long term. I think second and related to that is diversification benefits and low correlation. So over a long horizon, gold shows little by way of correlation to stocks and bonds in particular. And that's especially important since 2022, when stock bond correlations are the highest they've been in over 3 decades since the Russia-Ukraine war and the Fed tightening campaign. The second point related to that is diversification. So adding a little bit of gold to your portfolio of stocks and bonds, whether it's a 60-40 or 70-30 split, and having a little bit more incremental gold, it does improve something that's known as a Sharpe ratio in the business, or that's your volatility adjusted return, your risk adjusted return, meaning you're getting more bang for your buck and a smoother ride over a long horizon by having some gold in your portfolio. As we mentioned in the previous episode, gold is a lower volatility asset than equities, not a higher volatility asset. And then the last point, and this kind of bridges to, I think, a lot of things Jim and Bobby and I were talking about the last episode, is post-pandemic, I really think there's this alt fiat demand for gold. What do I mean alternative fiat? Just demand for non-fiat currency assets. So these are hard assets or digital assets. I think that demand has really increased since the pandemic for a host of factors.
Okay. Bobby, I was going to add something real quick about Jared Dillion's book, Money No Worries, that came out last year. And he's back tested since 1970, a portfolio that was 20% stocks, 20% real estate. And you can do these in ETFs, 20% gold, 20% bonds, 20% just cash on the sidelines. That portfolio over the last 55 years has averaged 8, according to Jared Dillion in the book, has averaged 8%. Is that good? Yeah, it's pretty good. Here's the great part. The biggest drawdown was 12%. So gold can be a big equalizer. You say, because we always say you should have a little bit of gold in your portfolio, and that's what I've believed for 20 years. Now I'm starting to believe that little bit should be a little bit bigger, by the way. And by the way, also, I think it's fair that when we talk about the lack of trust in fiat currencies, I think we have to mention the B word too, Bitcoin, because that belongs in that discussion as well. But gold certainly has the history by about a couple 10,000 years. Bobby?
Yeah, obviously we believe everybody should be sort of buy and hold equities over the long term, right? I mean, I don't think anybody here is saying that you shouldn't be doing that. What Akash means about it should be a key part of your investment portfolio, and I couldn't agree more. When you look at the average returns for the S&P historically, 7 to 8% ex dividends, close to 10%, inclusive of dividends. And people will sit there, and I had someone say this to me the other day, well, the S&P beats gold and average annual returns. Technically, yes.
Sure.
But I used to be chief investment officer, co-chief investment officer at a hedge fund I was at for 8 years. And if you brought me the S&P's return profile, we would have thrown it out because the drawdowns reach 40 to 60%. And every 5 to 7 years, the S&P declines 30 to 35%. Gold does nowhere near that. Nowhere near that. So on a risk-adjusted basis, if you want to sleep at night, gold should absolutely, as Jim just mentioned, as Akash just mentioned, be a part of your portfolio because it is an equalizer. It actually works that way. I have nothing to sell you guys. It actually works that way.
Great. Okay, so Akash, you mentioned alternative fiat. So how does that link to the U.S. and global debt and budget deficits? How does that all play out?
Sure. Let's play a little game of bar trivia. It's not fun like sports, movies, or even guitars, what we were talking about last episode. And I'm staring at my vintage ELP electric and Fender acoustic right now. Unfortunately, I have a dorky background instead of those guitars hanging up behind me, but I'm staring out on the other side of my office. But within that context, let me ask Jim and Bobby, global sectoral debt. So I created and looked into this series. This is corporate, household, government, financial, globally. So US, China, the major European economies, et cetera. Globally, what do you think that number is? Just throw it out there.
30 trillion.
That's just the US is higher than that on the government side.
I should
This
know
is
this, by the way. I'm embarrassed now because this is what I study all the time.
Yeah.
I should know this.
I'm gonna go
I kind of threw it on the
110
spot. So let me just say global debt, government,
60.
financial. Okay, you have 60. Do we have anyone else on a
I'll
guess?
go 110 trillion.
No, I just remembered the number. I think if I'm remembering correctly, it's 200.
200?
Even higher than that.
It is.
That
Wow.
number is 325 trillion at the
Wow.
end of the first quarter of 2025.
Wow.
That's more than three times global GDP in nominal terms in current US dollars. So what does that mean, right? I think there's two things that you could say to that. So Akash, global debt is at an all-time high. Well, the population grows every year as well. So congrats, genius. What does that mean? I decompose that global debt number to what the percentage is in government balance sheets. And we've had two big events over the last 15 years that really changed that. One was the global financial crisis. So going into the global financial crisis, government debt as a share of total debt was going down. It soared during the global financial crisis and continued to rise. And then again, into the pandemic shock and the 2020 COVID shock. So not only is global debt at 325 trillion all-time record, the government share of that debt is about 30% now, also at an all-time high. And what I think that does is it just leads to this lack of trust. It leads to investor concerns about fiat currency depreciation, and it does lead to demand for what we call alt fiat. And this very much links to a point that Jim was saying earlier, whether it was this episode or the last one, I can't remember, but he was talking about gold and Bitcoin and how you can't ignore both. Look, I was a founding member of the cryptocurrency research group at a major Wall Street bank back in 2018, helped build a Bitcoin model. We looked at this stuff in detail. And what I could say is back then, gold bugs and crypto bugs would fight each other. That would even be true as recently as 5 years ago. I think today it kind of coexists. You have crypto and Bitcoin is kind of your right tail event. And then you have gold, your traditional hard money going back 6,000 years as your left tail event. And they kind of coexist in that regard, with the overlap being this alternative fiat, de-dollarization, anti-fiat kind of story.
And let me add something too, is we're talking about gold as a way to gain a return. And that's one way to look at it. It's a great way to look at it too. But really, the overarching theme here is you're trying to beg, borrow, and steal to protect your purchasing power of the dollars you have in your pocket. So you can't just have things, and you can't have your cash and sit in your cash in your mattress. You have to earn a return that's better than the rate that they're devaluing these currencies. And that just doesn't go for the dollar. It goes for all of them. So this is a mad scramble to in my portfolio to protect my purchasing power is gold, silver, platinum, copper, Bitcoin, and real estate. And I'm a little bit off real estate right now because I think that is turning around in the short to medium term. But I think this is all about keeping yourself from going broke and being like, oh, great, I'm a millionaire. What the hell is a millionaire anymore? And I'm not trying to say, I'm saying into the future, what the hell is a millionaire anymore? It's going to be a millionaire is going to buy you parking and lunch.
Bob,
I have to throw a disclaimer in here. This is my opinion, not State Street's, not Tradier's, not Jimmy's. It might be Jimmy's. I have several different formulas that I use to value gold. And the one that I put out publicly is I think gold is going to hit 4,800 in the next 3 years easily. I actually, in my math, I think a year and a half, but I put it out as next 3 years. I have another model that says 341,000 per ounce in gold. I'll only say
I'll go with that one then.
Yeah, I like that one.
No, because that'll mean that things got really bad. I'm not going with that one. Yeah.
Here's why I say that. Akash brought up the great financial crisis, and that was sort of the big bang for devaluation of fiat, right? And it has not turned around since, and I don't expect it to ever turn around at this point. It reminds me of some of the traders we all knew in the 80s and 90s who were going to try drugs once, right? They just kept going. They didn't stop. And this is the narcotics of the financial world is printing money. and devaluing currencies. And to me, it's just not going to stop. So when you look at it from that perspective, gold to me, the other thing about cryptocurrencies, Bitcoin, and I say this over and over again, Bitcoin's going to 0 or 1 million. That's just my feeling on it, right? Gold's never going to 0. It's just not. Again, my opinion, you guys have to say past performance, blah, blah, blah. I don't have to say that. Gold's not going to 0. Bitcoin could. I think it's a lower probability event, but it could. I don't think the probability is 0 for Bitcoin going to 0. I think the probability for gold going to 0 is 0.
Okay, good. So a lot of people might be thinking about silver as a cheaper alternative to gold. Does this make any sense to any of you? Akash, we'll start with you.
Yeah, look, I don't want to trample on what Jim likes in his kind of alternative or anti-fiat portfolio. I think there's a time and place for tactical allocation to silver, and there are going to be periods of performance. And really, the last 3 months, silver has actually done quite well. What I would say is that they're not a substitute for gold. And I would say any of the precious metals. So let's say platinum, palladium, copper is a base metal. I don't think anything's a substitute for gold for a whole host of reasons. One is gold is a low volatility asset. I want to keep re-emphasizing that. We talked about it a lot at the first episode. It's lower volatility than equities. Silver is higher volatility than equities. Number two, what is its demand component? Gold is embedded in the monetary system. Central banks buy gold. It has cultural and religious significance. It has jewelry demand, fabrication demand for technology, bar and coin demand, and so forth. Silver is a precious metal, but it's very much tied to the industrial cycle and PMIs and industrial activity. In fact, about 55-60% of silver demand is linked to industrial input. Less than 10% of gold fabrication demand, ex-jewelry, is linked to industrial input. Silver also tends to have a little higher correlation to equities than gold, and so forth. So I think for various reasons, I think silver can work in certain environments. It can be a tactical allocation, but really it doesn't have the same role in a portfolio as gold to me. And I say this about gold among all other commodities, actually. Gold is unique in that regard. I think, was it Bobby who said in the last episode, show me something that's both a commodity and a currency. I challenge you. And gold really is unique in that regard. In a previous lifetime, I once wrote a paper about gold and the FX inflation gold and the FX inflation and commodity trinity. And it is really unique in that regard because of its historical and cultural significance that really embodies it as well.
Right.
So the one I don't wholly disagree with anything you're saying. Now, from a trader standpoint, historically speaking, when gold has these great, huge moves higher, silver lags right up until the moment that it doesn't. Prior to 2017, the gold silver ratio used to hover around, I want to say around 75. And again, this is thumbnail stuff, so nobody call me and say you were off by 5. And then after 2017, until like about a year ago, that ratio bumped up to like 80. And then all of a sudden, we did a show in Tradier where gold silver ratio was 104 just a couple short weeks ago. And, and a caller was like, should we put on the pairs trade? You sell gold and you buy silver. And Bobby's response was, which I would have given the same response, is, well, no, I can't be selling gold here, but I would be buying silver, which I did and have. And then silver plays catch up at a rapid response. Now, you talked about the fact that gold is purely a precious. And that's, that's very, very true, where silver kind of bounces back and forth between the industrial and the precious camp at the market's whim. But when it shifts hard. So I like to have an allocation to silver as well, particularly if you can get it when the gold silver ratio is, 3 digits like it was a month ago.
I always tell people if I traded silver as much as I traded gold futures, I'd be broke, because every time I try to trade silver, the volatility that Akash talked about always got me. It's just always with me. So I stopped trading it. And I always feel like anytime I think I should buy silver, that I should either buy both or I should just buy gold. The gold silver ratio historically was about 50 to 60 to 1 over the long term.
Long, right.
That's the amount of ounces of silver needed to buy an ounce of gold. But over the last 15 years, it's closer to 80. And I think the mean is moving higher and is probably going to continue to move higher. And to touch on platinum and palladium, Silver, platinum, and palladium, to me, while they are precious, are moving much more into the industrial metals sector. I think probably 20 years from now, when all of us are probably still investing because we're poor, you're going to see those three be called home. Yeah, they used to be precious, but now they're industrial. They're just precious because of their scarcity. You got hydrogen storage for palladium, for example, which is just going to be used more and more. Chemical catalysts that platinum is, and the conductivity of silver, with the world getting more and more electric, despite what you believe of climate change or not, the world is going more and more electric, and that's not turning around. So part of the reason Jimmy owns so much copper. You look at it from that perspective, I think gold again remains the only currency and asset that's out there, unless Bitcoin gets better at it, which right now it hasn't done yet.
Great points. So you mentioned, I think you touched on supply a little bit. So what role does supply play in gold price discovery? They're like grains of sand. Seems like a lot, but they run out at some point, right? There's only so much.
Yeah, look, gold is a finite resource, but there is new supply every year. The way gold supply works is kind of three different sources. One is new primary mine production, digging the ore out of the ground and then refining it. The second is gold recycling or gold scrap. This is true for many metals, including copper. It's just basically taking gold, and in the case of gold, it's jewelry. In the case of copper, it could be underground wires, washing machine parts, etc. You're recycling that scrap. So that's the second source. And then the third source is destocking, whether it's from the ETFs or the central banks and so forth. What I would say is really important for gold mining supply is that it's growing, but it's growing at a very slow rate. Typically 1.5, 1.75% per annum is the long-term trend. So as Jim mentioned earlier, maybe it was the last episode, what's M2 supply growth at? Is that growing higher than the gold supply or lower than? And then I think a lot of times on gold, we focus on the demand drivers, because really it's the aggregate demand curve from an Econ 101 standpoint that drives the gold price. But I do think supply is important. It's unique for gold versus other commodities. Typically, other commodity prices will be at all-time highs or really rise when there's a supply shock. So if oil supply goes down, prices are up. Corn supply goes down, corn prices go up. In the case of gold, actually, you have record prices, but you could have record supply. This year will be record gold mine production globally. There's no question about it. That is in all the models and all the forecasts across the banks, the World Gold Council, and so forth. That being said, that's a different relationship than you see in other commodities typically, because that supply is reacting to the shift out in the aggregate demand curve and the need for that supply to hit the market to meet that demand.
Can I ask Akash a question here real quick?
Sure.
And this goes on for decades, me watching gold. And it's happened within this week, I believe, with a big discovery or location of a mine in Africa. Do you guys know what I'm talking about? There was a story I was just reading a couple of days ago that I don't know where it is exactly. But this happens every couple of years. And it never really affects the price of gold too much to the downside. And what I've always figured, and Akash, this is a question, is that just locating, saying, yeah, there's a bunch of gold down there, that's way different than having gold bars in your hand. And there's a lot of steps and hoops to go through before you get it, correct?
Yeah, and this could be for a follow-up podcast and discussion, but commodities are hard assets that have costs of production.
Yep.
So absolutely, just because you have a resource in the ground doesn't mean you can extract it efficiently and effectively. So is there a technological know-how? Is it cost effective? Is the political environment allowing me to extract that, and so forth? So I think in that context, what I would say at a very high level, Lex and Bobby and Jim, there is no, without getting nerdy about commodity, there's no US shale for gold. You can't just turn gold supply on and off. Yes, there are mine discoveries. Yes, it's typically found in very exotic regions across 6 continents in the world. Maybe they'll find some in Antarctica and make it all 7 at some point. But within that context, it's something that grows at a very slow and steady pace. There's a lot of politics involved. There's a lot of cost curve factors involved. So it's not an easy resource to just extract and push out into the world. And I completely agree with you. That's a great point, Jim.
So can I just throw in, first of all, there's no, Okay, so this is kind of like, I'm going to say this quickly. That part was a lie. This is kind of like something that's been in my wheelhouse for a long time because I worked at an energy firm for a while doing geopolitical strategy and stuff. And I learned quite a bit about crude oil. And I learned that shale doesn't have an on or off switch either, right? There's costs involved, as Akash mentioned. And if the cost of oil goes too low, the supply shrinks. Oil price goes up, the supply expands. But it takes time and money to get that supply to expand. It's even more so for gold. Talking about nerding out, Akash, you talk about your nerdy background. Gold was formed in freaking stars. I mean, it's like that's how gold was formed in the heart of dying stars. It's like it's out of Marvel or something, like it's out of the Marvel universe. It's one of the coolest things I ever had. That's why I think Italians like gold so much. I have a gold wedding ring on. But I'm getting all excited about it because it's just so cool to me. But humans have actually succeeded in creating gold. But the cost of that creation, first of all, they produce like picograms worth of gold. And the cost to produce those picograms equated to more than all the gold discoveries they knew at the time added together. So that went out the window. That was never touched again.
Yep.
The one thing that I mentioned, my one model that points to $341,000 an ounce for gold, that assumes no more supply ever. That's the hitch in that model, which is why I don't use it much. I think technology is one of the sort of chinks in the armor of gold price continuing, because just like oil had shale, which came about in the last 15, 20 years, at some point they will likely have technology that gets gold deeper out of the Earth's core. They'll find more gold. It'll be cheaper to get it out. But that is a long process. That is a very, very long process. And that's why I think we're talking about probably a decade or more before that technology starts to peak and produce enough gold to affect the price. As Jimmy said, the gold supply that comes out of the ground now, they find it, they say, okay, we're going to get this out. We'll see you in 7 years. And then after that 7 years, they may not even get as much as they thought they saw. So it's a critical component, Lex. The supply issue is a critical component to it. We should also talk about the recycling of gold, which is about 25 to 30% of the supply every year. People sell gold and it gets recycled back into the open market. And I don't think we're going to see this for a while, thanks to the U.S. government's the last 3 or 4 administrations. Central banks could start selling gold at some point, which will be seen as supply. But they're not even done buying yet, so I'm not worried about that either.
Okay. All right, great. Well, that's all the time we have. I appreciate you, Akash, for coming on and giving us the whole skinny on the GLD and gold at large. We love that. Bob and Jim, thanks for helping me out on the great discussion. That was awesome. So it was a 2-parter for everyone. It will be available at the Tradier Hub, hub.tradier.com. And if you like this kind of material, I know Bob and Jim talk about it a good bit on their show, Trader's Edge, Wednesdays when?
4 o'clock Eastern.
4 o'clock Eastern. Those two guys are cutting up the whole time. I've seen them live in person do it too. So Akash, again, thanks for coming on. This was really, really informative. I think the folks are going to really like this. So appreciate you.
My pleasure. Thank you so much.
Thanks, guys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.